WG Hub Live on this Friday. Normal spot. This time we're talking about, as part of our series on strategies for the pandemic and beyond, we're moving on to a bit of tax planning this morning, strategic tax planning. And this morning I've got our team, our own Ward Goodman team on, and so I'd just like to do a quick welcome to everybody. So good morning, Stephen Martin.
Morning. Thanks for joining us. This morning I'm just going to be covering a bit about where we are as a nation as a result of the pandemic, some thoughts as we're approaching the year end, and then 4 specific areas of interest being pensions, property, capital gains tax and inheritance tax.
Fantastic. No. Well, thanks, Stephen. Thanks for joining us this morning. I know it takes it takes a lot to put these presentations together, but we're looking forward to it. And also on the panel today, got our own Gareth Simon, Director of Financial Services. Good morning. And also Alex Foster. So we've got a full suite of Directors of Financial Services this morning. So feel honoured this morning, guys. So a few of our normal housekeeping items. So we've got the Q&A. So if you can please put your questions through the Q&A, enables us to see them, enables the panel to have a look at them, and then we can answer as many as we can in the second half of this morning's WG Hub Live. So if you can do that, you can also ask questions through the chat, but it'd be better if we sort of had the commentary going through the chat, if we can. This morning, I just think we might just have a. Did you see the opening slide with the 4 guys on there? We might just have a bit of a laugh this morning because it did look like a boy band from somewhere in. I think it might be a 1980s, touch 1990s. I think some of the guys. So maybe if you want to put a name for our new band through the chat, we won't be offended. Well, not much anyway. But if you can do that, we could have a bit of fun this morning. Okay. Well, thanks very much for joining us. We do appreciate your company, and we better move on now and get started then, Stephen. Is that all right? Can you share your screen?
Yeah, that's absolutely fine. Would you bear with me? So firstly, I thought I'd talk a little bit about the actual private client team at Ward Goodman. So this is a dedicated team of professionals, tax professionals, that we're happy to deal with all aspects of kind of personal taxation, trust and estates, private wealth planning, and kind of business planning for your family business. We're fully aligned with the other services of Ward Goodman to deliver the best possible service to our clients, helping them to achieve their personal objectives for themselves and their families, as well as their business and that. If you've not heard of the private client team before, we do have a brochure. So if you've not seen that and you'd like to know a bit more about us, just request a brochure and we'll get one sent out to you. As I say, this morning, I'm going to discuss kind of a bit about the result of the pandemic, kind of where it's left us as a nation, where personally I think we're headed as a result. I'm going to move on to some thoughts for planning kind of pre the end of the tax year that's coming up. And then I'm going to move on to 4 specific areas of interest being, as I say, pensions, property taxation, capital gains tax and inheritance tax. Anyway, so as I say, a bit of background as to where we are. Some recent figures from the Office of National Statistics estimate that in the first half of this financial year, the country's borrowed 208 billion, which was nearly 4 times the amount borrowed for the whole of the last financial year. It's estimated to have been 36 billion in the month of September alone, which is 28 billion more than the same period last year, and the 3rd highest borrowing in the month since records began. Public debt has risen by 260 billion in the first 6 months of this year to reach just over 2 trillion at the end of September, which is more than 100% of GDP. So I hardly need to tell anyone that these are extraordinary times, but I do think it's useful to put into perspective the cost to central government of some of the pandemic assistance, such as the furlough scheme. On the other side of that, there's more bad news, I'm afraid. Not only is borrowing up, but receipts are also down. Tax and national insurance receipts for the 6 months between April and September fell by over 11% compared with last year. In September alone, receipts fell by 13.4%, which is 6 billion less than the same period last year. In my view, this is set to continue into the new year, kind of, and beyond, as businesses and families continue to struggle with the effects of the pandemic. So as a result of that, my view is that I think all we can do is expect some major tax rises in the coming year. So the next budget is expected in March of this year. I think we're going to see increases across the board for the highest and lowest taxpayers. As is always the case, a small tax rise for everyone brings in a lot more revenue for the government than a big tax rise on only the very highest earners. As a result of the recent election, the Conservative Party obviously had a manifesto promise not to increase taxes. So although they might not necessarily increase the headline rates, we will see a reduction in reliefs, I think. So the headline rate doesn't increase, but you reduced the reliefs, brings in more tax. I think politically, they've got nowhere else to go. I don't think there's any appetite for further austerity. So I think all they can do is raise taxes. So I think we need to be prepared. So we've still got, the good news is, on the other hand, that we've still got 4 months left of the current tax year to consider everybody's tax position. So in my view, we're kind of in a use it or lose it position now. So kind of the basics that as we approach the tax year end, everyone should be ensuring that they're utilising their full personal allowances and basic rate bands where possible. Look to split income between husbands and wife to ensure that both parties, where you're married, are using all your reliefs. Where possible, and you've got flexibility over the income that you're taking from your business, you should look to be avoiding income falling between the 100,000 and 125,000, where you lose your personal allowance. Again, where you're extracting your income from a business and you've got some options, you should maybe consider some tax-free or low tax alternatives to taking the salary. A couple of examples would be pension contributions or zero emission cars. Zero emission cars have been in the press a bit recently this week as well, but they currently still remain a tax efficient way to extract profits from your company. I'm going to come on to capital gains tax in a bit more detail later on, but we currently got historically low rates of capital gains tax. So now might be the time to kind of consider your portfolio of assets and whether or not you wish to realise gains now to utilise those lower rates of tax. Again, if you've got rental properties, I'm going to cover these a bit more again. You might consider just restructuring the portfolio slightly, transferring properties to spouses or various options there to make sure that you're both using your personal allowances and basic rate bands, and to avoid hitting some kind of horrific excessive rates of tax. Where possible and where relevant, if you've got children, if you can keep your income below £50,000 a year, you can retain your child benefit, which is always handy. And as I say, in restricting reliefs going forwards, kind of ISAs at the minute, there's large ISA allowances of £20,000 a year you can make contribution to an ISA. Whether or not these are reduced slightly is remains to be seen. So use those tax incentive wrappers now. make sure you're getting the contributions into those ISAs and look at other tax efficient investments. So I think, Gareth, you've got something to add here?
Yeah, thank you, Stephen. Yeah, I think the point we'd make from a financial planning point of view is that if you're not quite in a position to necessarily make a decision on the underlying investment within a pension wrapper or an ISA wrapper, you could always make the contribution as cash. The thought process being there is, as Stephen mentioned earlier, that it's a use it or lose it situation. So if you make the contribution into your ISA as an example, but make it as cash, then you've secured your ISA allowance and you buy yourself a bit of time to then get some appropriate advice in terms of the underlying investments. So there's ways of securing the allowance without necessarily making a decision on the underlying investment. That's probably one point I'd make. In terms of with pensions, you have got the ability. I think Stephen's going to go on in a minute to talk about the ability to carry forward pension allowances from previous tax years. You can't do that in terms of ISAs. Obviously, if you don't use your ISA allowance, it's gone for that tax year. So making a cash contribution is one option. What again Stephen mentioned about the fact of potentially bringing forward some sales, in terms of if you were planning to make sales within your investment portfolio or your property portfolio, then yes, maybe now's the time to think, well, if you were putting it off for next tax year or the future tax years, it may be a good time to review your strategy. All I'd probably say is that the tax strategy is important. I think it's important to try to minimize the tax where possible. But the benefit of the Ward Goodman approach is we look at it from a holistic point of view. So whilst tax is important, we will look to see whether actually does it fit in with the overall investment strategy, your overall financial plan, because the order of events or the order of sales is just as important. Probably the other thing to mention is that in terms of the potential tax changes on the horizon, it may mean that other tax wrappers need to be considered. The typical tax wrappers we talk about are pensions or ISAs, individual savings accounts, but there is another tax wrapper that we use a lot at Ward Goodman is what's called an investment bond. It's another tax wrapper. It's provided by insurance companies. And again, it's something that you can just wrap around a portfolio of investments. We can talk about that in a bit more detail later, but it's the potential tax changes on the horizon may well mean that clients need to consider other tax wrappers, perhaps apart from what they're used to.
Okay, thank you, Gareth. Just thought I'd mention some other recent announcements. So within the last week or so, the Treasury has announced that they're going to continue to keep the annual investment allowance at £1 million for the next current year, the next tax year, which is good if your business is looking to make substantial capital investments. R&D tax credits are going to be capped to £20,000 plus 300% of total PAYE and NIC. I think next week's hub's going to cover R&D in quite a bit more detail, so I'm not going to go into that. And they also announced a delay on making tax digital for corporation tax. So the pilot's been postponed until April 2024 and won't be mandatory until April 2026 at the earliest. So moving on to a couple of specific areas now. I'm going to start with pensions. Pensions have been a hot topic for the last few years now. Before budgets, there's always been a lot of noise around reducing the amount of tax relief that's given for pension contributions, as it's deemed to be unfair in the sense that relief is currently given at your marginal rate of tax. So higher earners that suffer kind of higher rate and additional rate tax receive full tax relief at their marginal rate of tax. So as it currently stands, you can invest up to your earnings in the year, up to the annual limit of £40,000, the annual allowance, £40,000 per year. And you can also carry forward any unused annual allowances to from the 3 previous years. This is subject to the lifetime allowance of just over £1 million. And there's also restrictions for higher earners in the amount of tax relief that's actually given. certainly anyone with income in excess of £100,000, I think should be seeking professional advice when it comes to making pension contributions. So the talk about restrictions on the tax relief in future years, there's been talk around a flat rate relief for pension contributions. So whether this is 20% or 25% isn't clear, but it's certainly something that the Treasury have been looking at for a number of years, and I do think it's something that they're gonna look at introducing. But when they do need to take care not to kind of exacerbate the issue of inadequate savings people have already for pension contributions. So I think now's the time, really, if you're thinking of retiring or thinking of investing, or even considering your inheritance tax position, now's a good time to kind of look at the reliefs that are available, work out how much you can contribute, and then make a view from there. Also, pensions are really useful in that you can make pension contributions for members of your family. So you could make a pension contribution on behalf of your children or grandchildren, and they receive the tax relief. Although you've paid the contribution, they'll actually receive the tax relief in their own tax calculations. For kind of children and grandchildren that don't have a job, you can contribute £2,880 to a pension contribution from them. That will still get grossed up and given basic rate tax relief. So that's a really kind of long-term view for kind of passing wealth on to the next generation. As I mentioned earlier, where your income exceeds £50,000, if you're claiming child benefit, that's withdrawn. So what you can do is make pension contributions to bring your net relevant earnings below £50,000 in a year, and then you regain the child benefit. So the actual marginal rate of tax relief given is a lot higher than your actual marginal rate of tax. Also, when thinking about pensions, it's worth, if you're thinking of withdrawing a pension, considering, do you really need that income coming out of your pension at all? And are there kind of other assets that you could use before withdrawing from your pension, and to avoid hitting excessive rates of tax? And it's worth kind of considering kind of your overall position in terms of that. And I think, Gareth, you're gonna come in here again with a bit more information.
Yeah, thanks, Stephen. Yeah, absolutely. At Ward Goodman, we've been looking at pensions as a way of sort of cascading wealth down the generations to family members for some time now. And absolutely, with the new pension flexibility rules as they currently stand, it is absolutely an opportunity that should be considered. So picking up on the point Stephen made there, historically you may have looked at your pension as a way of creating an income, but actually, if you've got the ability to pass pension wealth sort of down the generations, it can form part of your inheritance tax plan strategy. Thus, if you can generate income from, say, investments or your property portfolio, whatever it may be more tax advantageous from an income tax point of view and an inheritance tax point of view. Now, again, it's been in the press, it's been widely publicised, a famous case called Staveley. It went all the way up to the highest sort of court in the land, and there's been a lot of press coverage whether actually the Inland Revenue were arguing that there was a pension transfer done in that case, and they were arguing that actually because of the transfer, the value of the pensions were taxable for inheritance tax purposes. Well, I'm pleased to say that case is now finished, and HMRC didn't win, which is good news. What it does mean from a planning point of view, that you have to be careful if you're looking to do a pension transfer and you're in ill health. You have to be careful, because that's basically what the Inland Revenue were going after. The fact it was done very close to, unfortunately, the death of the individual. But we have had it confirmed that if it's a what's called a defined contribution or a personal pension. So what I mean by that, it's not a company pension or a final salary pension. If it's just a money purchase defined contribution pension transfer, then if you do a transfer and you die within 2 years of death, then it won't be taxable for inheritance tax purposes. So it was a big decision, and it's an important decision because it's, as I said, it's a big planning opportunity around pensions. A couple of other quick points to mention just on the pension aspect, just linking it to tax, is that it's really important when you're looking at your overall estate planning, drafting your will, looking at your pensions, that if you put together a letter of wishes and it does cover your pensions, it's important that the letter of wishes isn't too prescriptive. What I mean by that is that it's really, you've got to leave the discretion to the trustees of your pension scheme and your executors of your estate. Again, because HMRC are looking at this very carefully, that if a letter of wishes is in place and it's giving direction to the pension trustees, then potentially they may argue that the pension benefits are then taxable on death. Again, it's just something to be mindful of. If you are, as I said, looking at your estate planning, your pension planning, it all needs to be linked together. It's something we look at for Ward Goodman clients all the time. But yeah, the key point really is discretion rather than direction. And the other point around pensions really is, in terms of the pension flexibility rules as they now stand, it's really important that you check your death benefit nominations. So you probably all got pensions. That's fine. They're all set up. Just double check the death benefit nominations in place for two reasons. The first reason is to make sure that if anything happens to you, you're leaving that pension fund to the person you want it to leave it to. So your nominated beneficiary, whether it's your spouse or your children or whoever it is, make sure that is up to date. And the second reason for checking the death benefit nomination is to make sure that your pension scheme can benefit from these new pension flexibility rules. Some of the aspects we've talked about today, some old style pension schemes don't embrace the new rules. What I mean by that is they're old style pension schemes that can't, in effect, provide the planning opportunities that modern pension schemes do. So just something to bear in mind.
Okay, thank you, Gareth. Moving on to let properties. Finance costs have been restricted for landlords, individual landlords on residential properties since April 2017. So tax relief for finance cost is now restricted to the basic rate relief of tax only. And as a result, this can push individuals into the higher rate tax bands, even though they're not actually realising a profit, a kind of a net tax profit of that amount. So people with let properties, I think, should be considering the structure of their property portfolios. So it is possible for married couples to transfer properties between spouses without suffering CGT, where those properties are unencumbered. Where they are encumbered, they will suffer a stamp duty land tax charge on those transfers. You could also consider incorporating your property portfolio into a company. Again, in doing this, in incorporating the portfolio, that isn't in itself tax-free. So you'll suffer potentially capital gains tax and stamp duty land tax on moving the properties into a corporate structure. However, once in the corporate structure, you'll benefit from the historically low rate of corporation tax, 19%. Where you hold a property and you're not necessarily reliant on that income, you might consider gifting that property into trust now to potentially protect yourself from future inheritance tax and to kind of divert that income into a different stream. Also, we seem to be enjoying a mini boom in property prices in the southwest. So you might consider, what with the historically low rates of capital gains tax and high property prices, maybe just selling the assets altogether and kind of looking to diversify your portfolio overall. So I think Alex was going to talk a bit more about that for us.
Yeah, thanks, Stephen. And you're absolutely right. There's been an increase in the last year, and according to Halifax Housing Price Index, they were up 7.5%, which is absolutely phenomenal. But that is starting to sort of flatten off. The most recent quarterly change was up 4%, and this month we're up 0.3. Now, there's a lot of press a couple of months ago in relation to how many mortgages were actually being signed off. And we're seeing some of this flattening now because there is an overpricing of some properties, and many mortgage lenders now are not agreeing to the valuations that surveyors are providing. So a lot of mortgages are being blocked. So this flattening is starting to sort of equalize the housing market out a bit. And as Stephen's quite rightly said, there's an element of diversification. With a lot of properties not being able to sell quite quickly, there is a liquidity issue around how properties are held, and that's both residential and commercial. Commercial property prices have dropped quite considerably at the moment, which is why people are starting to look at realigning their portfolios. And also investments historically in the BH postcodes, DT, the SP postcodes and the SO postcodes, so our local areas, the dividend yields, the rental property yields are about 3.5%. Well, if you look at an investment portfolio that isn't just in one asset class, you can be generating anywhere from 3.5% to 4.5%, even in some of the decreased dividend rates that we're getting at the moment. So there's an equal ability to generate an income from an investment portfolio as is would from a property portfolio. Now, it's not to say one is better than the other, because everybody's got different needs and everyone's got different objectives. But there is a point in the market that Stephen and I are both working on at the moment where several clients are looking to use this opportunity to either incorporate some properties into businesses because they're lower than the stamp duty threshold currently, which is 500,000 with no stamp duty. And they're able to make those moves without that sort of tax. There is a stamp duty land tax of 3% if you move it into a company, but people are still enjoying or trying to enjoy some of those tax breaks. And if there are capital gains tax in the future and they are going to be increased, it is an opportunity to sort of utilize the lower CGT at the minute. And then the other side to it is what's going to happen with the income, whether people sort of diversify. If we're looking at the housing price index, we are up at the moment, but historically it's sort of grown by 2 to 3% year on year. Whereas portfolios at the moment have grown at about 16% over the last sort of 12 months or even 12%. And historically over the last sort of 5 years, some are up to about sort of 65%. So there isn't a capital growth element, there is also an income growth element. And it's trying to weigh those two up and actually making sure that people have got liquidity in their portfolios from every different angle. And as Stephen said at the start, that's why the alignment between tax planning, business planning and financial planning is so key to what Ward Goodman are trying to do at the moment. But yeah, back over to you, Stephen. Thank you.
Thank you, Alex. I want to move on now to talk a bit about capital gains tax, and specifically the Treasury recently asked the Office of Tax Simplification to undertake a review of capital gains tax as a whole. So that first report from the Office of Tax Simplification was published last Friday. The aims of that were to look at simplifying the design of capital gains tax. But having read that report, it's actually very detailed and it goes quite a way further than that. So kind of the headline rates, you might have seen quite a bit of this in the press, was kind of moving more closely to align the rates of capital gains tax with income tax. So currently there's kind of a perceived inequality between earned income and unearned gains. So at the minute, earned income taxed at 20, 40 or 45%, capital gains taxed at 10%, 20%, or for residential property 18 and 28%, depending on kind of where you sit within those bandings. So this is a move they're suggesting back to kind of how things were 20 years ago, or how things were for 20 years up to 2008, where capital gains tax and income tax were aligned. These proposals, they say, would raise around 14 billion in extra revenue for the government. They talk about reducing the annual exemption. So currently the annual exemption is quite a generous £12,300 per year. They consider proposals include reducing that to just over £2,000, which would obviously draw a lot more people into the capital gains tax net. They talk in quite a lot of detail about removing the capital gains uplift on death. So currently, when someone passes away, all of their assets are rebased in their estate to the probate value. So they're talking about removing that. So that means that kind of when you die, the estate's going to be liable to capital gains tax on the increase in value from the date that the asset was purchased to the date of death. As well as then suffering inheritance tax. So they're looking kind of there at potentially taxing assets twice on death. They do talk about reintroducing a relief for inflation as a result of kind of the increased rates of tax. So anyone who remembers how indexation used to work, I'm not sure that that's specifically a simplification, but it's interesting to see what they're saying. They talk as well about completely replacing business asset disposal relief, or entrepreneurs relief as it was called, with a relief that is much more focused on people who are actually retiring. So kind of to put some figures on this, a high rate taxpayer making gains up to the annual exemption currently of 12,300 wouldn't pay any capital gains tax at all. Under these new kind of proposals, someone with the same income making the same gain of £12,300 would have a capital gains tax liability of around £4,500 a year. So you can see that these are really going to, if these changes are implemented, they're really going to bite. As I say, the report went quite a lot further than just the simplification of capital gains tax. So it also looked at kind of the interactions with the tax position of companies. And again, there's a perceived inequality and a perceived change in distortion in people's behavior, that they aim to kind of get gains within a corporate structure. So as I said previously, corporation tax is historically low at 19%. So the proposals go quite far, and they say that where people have moved assets into a corporate structure, like a family investment company, for example, to maximize these low rates of tax, they're looking to tax the retained earnings within the company at rates similar to income tax, rather than just when the shareholder withdraws those assets or that income from the company. And kind of the balance of that is, where you do own assets within a company, you pay corporation tax on the profits generated within the company, but you also pay a second layer of tax when that income is extracted from the corporate structure. And as a result of this, the overall tax that you pay is often higher than if you'd held those investments personally. So I'm not really sure where they're going with this perceived distortion, but it is something that they're certainly looked at, and they've looked at it in quite a lot of detail in this report. So I think now is a good time for everybody to consider kind of what assets they're holding, kind of what potential capital gains tax liability there is on those assets now, whether it's worth crystallizing some of those gains now. As I say, we've still got 4 months left of the current tax year, where we know what the tax rates are, we know kind of what exemptions and reliefs we're entitled to. So we can have a good look at your portfolio of assets now, and maybe you'll consider crystallizing some of those gains now, before hitting these higher rates of tax that are proposed. Moving on to inheritance tax. As most people are aware, inheritance tax is a widely hated tax, I guess. It's currently charged at 40% on estates over £325,000. So you've got your £325,000 nil rate band, And you've also got residence nil rate band of £175,000. So potentially an individual can pass on £500,000 of assets when they die before suffering any inheritance tax. For a married couple, that can be up to £1 million, where assets pass to the first spouse on death. So up to £1 million before suffering any inheritance tax at all. There's definitely an unfairness here, in that it's only £1 million if you have children and you're passing assets to those children. So a married couple that don't have children, they can only pass on £650,000 before suffering inheritance tax at 40%. Gifts of cash currently free from inheritance tax after 7 years, and relief is given for business and agricultural property. So the Treasury a couple of years ago asked the Office of Tax Simplification to look at inheritance tax, and they produced 2 reports, one in November and one in July 2018-2019. These proposals completely overhaul the way inheritance tax will work. So they're looking to introduce a lifetime gift allowance of £30,000 per annum, and any gifts made in excess of that limit would be subject to an immediate charge to tax. So you can no longer just pass assets down the generation potentially without suffering a tax charge. Again, this went into quite a lot of detail about removing that CGT uplift on death. So currently, if you've held an asset for a considerable amount of time and it's sat on a substantial gain, if you're at a certain point in your life, you'll know that you don't want to sell that asset to kind of trigger a capital gains tax liability. You'll just hold that asset till you die, where that gain will drop away. So they're talking in quite a bit of detail here about removing that CGT uplift on death. So again, you're going to have two double tax on assets when you die potentially. So it's going to be interesting to see what they actually do. Part of the proposals as well went into a lot of detail around trusts, and it suggested that discretionary trusts would be subject to a new regime, a completely new regime, which would comprise of annual charges calculated on the trust value, and then charges when the assets actually leave the trust, which is quite a change from how things currently work for discretionary trusts. I think there will always be a place for trusts, regardless of the tax implications of holding assets in trust. Just they're such a useful vehicle for asset protection. I think there's always going to be a place for a trust. So in summary, I think we're clear for a major shift in the tax on individuals in the coming years as a result of this pandemic. I don't think it's going to be pretty. I think there's going to be some big increases across the board, whether you're just someone on a low income or a high net worth individual with a lot of assets and a lot of flexibility about drawing income from a company. I think we're in for a major shift in the coming years. I think now's the perfect time to review your tax position with your advisors, kind of formulate a plan. We can help clarify your thoughts on where you are and where we're headed, and any potential impacts on you personally that we see coming down the road. And in reviewing your affairs and your tax position as a whole, even if you decide to do nothing, at least you'll know where you are, and it will help clarify your thoughts at this stage. And Ward Goodman here to help. So as we said, we're a fully aligned team. We work well together, and we come and have a chat. I think the tagline is at Ward Goodman, it starts with a conversation. So come and have a chat. Is that right? Is that right, Ian?
That's right. Yeah. Yes. All good relationships start with a conversation. So yeah, let's talk. That's the way forward.
Yeah.
Absolutely right. Well, thank you so much, Stephen. That's a great presentation. Thank you, and thanks, Gareth and Alex, for your contributions to that as well. That was terrific. can I just ask for the questions to go in the Q&A for all our viewers at the moment? If you can put your questions in the Q&A, that would be fantastic. I have to say, Stephen, obviously I deal with a lot of businesses, and I think that there's a little nugget in there, which I'm not sure how many people will pick up on, the retained earnings issue that may or may not come up. But obviously we get a lot of business owners who actually don't max out their tax position for whatever reason, and there are a lot of people out there who aren't doing that, especially going up to that 100,000. Maybe they could take it out, but they actually leave the reserves in the company because they don't quite need that. But what we're talking about here is a case of actually maximizing that position. Do you think?
Yeah, absolutely. So I think even if they don't tax retained earnings within a company at the individual's tax rates, I think I wouldn't be surprised if we saw an increase in the level of tax on dividends at the minute anyway. So now might be a time, if you've got reserves within your company, now might be a time just to review whether or not it's a time to make a special dividend before we hit the next tax year, to kind of extract those profits from the company at a potentially lower tax rate. Because
I mean, I know we talk about this a lot, that actually once the money's into the owner's hands, they can always, they can actually lend it back.
Yeah, absolutely. Yeah. That's it.
Yeah. Okay. But, and obviously there's a lot there on pensions and maxing out those positions, guys. So.
Yeah. I think it's something, Ian, that people have got to think about very carefully. As I said earlier, even if you don't want to make a commitment to the underlying investment, you could still make the contribution into the pension in the form of cash, whether that's into your own personal pension, making an employee contribution, or if it's a business owner making an employer contribution. It's undoubtedly, as Stephen's outlined, there are big tax increases on the way. So yeah, I think just some proactive planning now can make a big difference.
Yeah. And you made your point there about Alex, about the diversification, that we've had a lot of investment in property, especially down in this area.
Yeah, there's a lot of money coming out of London. People are starting to understand that you don't need to necessarily be in London and sort of be stuck in a train, which actually is not a bad thing at the moment because there's nobody in them. But where you can actually be working from home, you can work from a beautiful area that we're all lucky to live in. So there is a bit of an increase, and as we look at any sort of diversified portfolio, you're always wanting to try and sell at the top. That's not to say that residential properties are at the top of their market in this area, but if they are going to make profits that they are at the moment, absolutely look to try and realign a portfolio so it's more diverse and a bit more liquid. So if the tax do change, as Stephen's alluded to, then you can actually have a better remuneration strategy as to where you draw your incomes from and not be sort of handcuffed by what the government do with the tax changes.
Yeah.
It's time to act.
Yeah. Okay. I think we've got a question coming in from Mrs. Lewis for Gareth. What is your view on the outlook for inflation and how will that affect your advice?
Yeah. That's a very good question. Well, unfortunately, the outlook for inflation is on the increase. It's going to be, we are going to have higher inflation in our view for a few reasons. Firstly, you probably noticed it already. I know we're in a sort of second lockdown at the moment, but even before this lockdown started, going for a haircut, hairdressers, the local businesses, they've all put up their prices by a couple of pounds, quite rightly, because they have to. They've got no choice, and they're obviously got, potentially extra expenses in terms of if they're wearing PPE or whatever it may be, or of course they've been closed for many, many months, so they've got to push up prices to try to obviously, in effect, repair the finances. So, that's just at a very sort of small level, local scale, in a, local barbers, local, shops. You've probably seen, the price of the weekly shop's gone up. Well, that's only going to continue. So, yeah, whilst the current rate of inflation, is around the government target, we expect medium to long term the inflation rate will go up significantly. Now, in terms of how that will affect our advice, well, from a client point of view, obviously, if you're sitting on large amounts of cash, then obviously cash is something that will get affected by inflation over the long term. It will erode the actual value of the capital. And of course, if you're reliant on your interest or income from cash or deposit-based investments, then again, obviously, higher inflation will affect not just the capital value, but the potential purchasing power of the income. So in terms of our advice, we'll probably be looking to say to clients, well, look, we might have to move some of the cash around, move it into alternative areas that we can potentially protect the capital from higher inflation. But yeah, higher inflation is definitely here to stay, I would think, for some time.
All right. Oh, it looks like we've got a suggestion for our band, the Balance Sheet Boys.
Like it.
Well, yeah, there's going to be some more. Oh, hang on, we have got some more. One taxation.
Yeah. At least you're all polite.
Yeah.
And tax that. There you go. Tax that. So it looks like our strapline might have to change a bit. But they're coming in thick and fast now, unfortunately. No, I mean, it's good. It is a fact that we have to right across our business. Tax is a focus, and we've made sure that tax runs right across our disciplines. So I think this is a great great show to be able to demonstrate that, really. Especially the interaction between business and financial services in terms of how you make your business work for you. I think that sort of all the way through the journey, from the beginning to the end. And as you get towards the end, you're mentioning there some some tax strategies to get you over, out of the business and beyond. And I think that's where our strength is, don't you think, guys?
Yeah, absolutely. And I think as we've spent over the last couple of sort of years in marketing, and over your left shoulder that you've got the swirl, and people, if they've been to our website, will note that the swirl has got different elements of planning, and the whole idea of that sort of planning is to make sure that we've got an integrated approach. And I know there's a lot of time and effort that goes between the different departments as to how we actually make sure that the clients are giving us information as to what they need. So that we can develop more services to continue to allow us to sort of help our clients. And again, over your left shoulder, your success as our business is exactly just that. It's trying to learn from a client need. And I think in a pandemic as such as we are, there's always learning. People have got new needs now that I don't think they'd even considered before. Us doing webinars, having Zoom meetings, there's clients and individuals have got different needs on an ongoing basis. So yeah, absolutely. The alignment's the most important thing.
Yeah, and you mentioned an important point there that actually, I know Stephen jested about, the fact our strapline, and it's all about the conversation, let's talk. But in these times, we're still finding that there's, a lot of people who do want to talk, and that we are still very accessible.
Yeah.
Oh, hang on, we got it. We have another. Well, thanks for the talk, guys. There's a lot of. Oh, hang on, we've also got the Wombles. Bit harsh. So anyway, like I said, we're open for chats about all sorts of subjects regarding tax and financial planning and the integration between that. So I think we ought to just we'll probably just wrap it up now and go for I keep these questions, they keep coming up, so I can't ignore them. I can't keep ignoring. So what timescale do the panel think we will see these potential tax rises being implemented?
The next budget is expected in March 21, so I don't think the Treasury can really afford to hang around on this. So I think they're gonna come in. I think they're going to be quite a shock to the system for a lot of people in terms of what's being proposed. So there's always something in the press. It seems to be kind of the way things work now. Things are leaked to the press way in advance of a budget. So they've been talking about restricting the pension tax relief for a number of years, but I don't think they've ever it's never been politically the right time to make such a significant change. I think now the pandemic's provided that opportunity. So I think that's coming for sure.
Yeah. Okay. Yeah, it's not long at all. So we do need to start talking now. Very important. So we've also got another question here. Do you think the stamp duty relief period will be extended? Stamp duty is generally one for the lawyers.
Yeah. It's certainly generated a lot of activity in the property market from what I've seen, but whether it's as generous as it currently is, I don't know. I wouldn't be surprised because it seems that people with second properties have also been taking advantage of this, in that they've only been incurring 3% stamp duty on properties up to $500,000. Whether or not they increase that 3%, so they might keep the 0% on your first or main home, but increase the 3% on second properties to 4 or 5%. They could look to do something like that potentially.
Yeah, no, absolutely. I know we've got some questions around income tax coming through. There's a few, but I think the interesting thing about the tax take for the UK is that most of it comes from income tax and corporation tax. That's right, isn't it, Steve? I think.
Yeah. So I think, I can't remember, an increase of 2% on the kind of the basic rate of tax brings in like 50 billion or something. The number's phenomenal in terms of what a small change to income tax brings in, whereas the whole proposals around capital gains tax that I spoke about were only set to bring in 18 billion. So a mix of the both, probably.
Yeah, income tax would actually be massive.
Yeah.
I think there's a political issue as well, though, isn't it? Not to get into a political debate, but I think obviously an increase in income tax is probably more of a political hot potato than potentially increasing capital gains tax, Stephen. There's a view that people that are selling assets and property and investments have potentially got more wealth than others. So there is that argument as well. And I think we've spoken a lot internally about this, and I think capital gains tax to me is the one that they'll go after, first, possibly before any income tax increases.
Yeah, I mean, it's an interesting one, that, because obviously when you set out a pledge, you don't necessarily know that there's a pandemic coming, a global pandemic. So it's whether anybody gives the government a little bit of leeway there. But also corporation tax, obviously, we have got historically low corporation tax. I mean, it was going to go down to 17% at one point, wasn't it, Steve?
Yeah, it was.
Yeah. So that was sort of halted at 19. Now there's we used to have two different rates for corporation tax for larger and smaller companies. Whether that comes back, I don't know. But I mean, obviously at the moment everybody's after getting businesses going again, and actually getting a tax take from businesses would be a great thing, won't it?
Yeah. So there was talk in that report about the simplification of CGT around closed companies, so kind of family-owned companies. So where the shareholders have got quite a bit of flexibility about how they draw that income. So whether or not they would target closed companies with potentially a higher rate of corporation tax on retained earnings, it remains to be seen. But it was certainly something discussed in that report. So it's something that the Treasury, to a certain extent, have looked at and are looking at. So, yeah.
And we've had a recent talks I know between each other about PPR, because obviously for most people that is the most valuable asset. And I know we've just got a question in about this, which is, do you think there will be a change? Do you think it will be, they'll subject our own property, our principal residence will become subject to tax?
In recent budgets, they've tightened up the reliefs around PPR. So when you sell a property, it used to have 36 months from moving out of the property for it still to qualify, and that's gradually decreased over time. So they have tweaked with private residence relief already. Whether or not they could politically take the leap of taxing people's gains on homes when they sell them, it feels like a bridge too far to me. But we are in kind of unprecedented times. So,
as you said, there's been changes with being able to pass your property down to your children has given you another extra band, doesn't it?
Yeah.
But as we know, in the south of England, a lot of those properties are worth more than £1 million.
Yeah.
Alex was raising the point there that actually more and more are getting into that bracket. So, So I think we might have to move to our final question, which was, how long does the panel think it will take? This is a big question, guys. How long does the panel think that it will take for the UK economy to get back to pre-COVID levels? I better take it. Look, Gareth.
I think that sounds like a question for Alex for me.
Yeah, go on then, Alex. Give it a go.
Alex.
I don't used to like to use the old sort of wording, but how long is a piece of string? In my normal sort of promotive way of Ward Goodman, I think that's a one-to-one conversation. So if you give us a call, I'll tell you the answer. But no, in all seriousness, it's like Stephen's alluded to on many counts. It's about a culmination of all the different taxes. So it's going to be quite a long time. If we look at sort of post-war, how long it took to repay the war debts through history, we're in this for a long time. And in fairness, so are our children. If you have them, they're going to be paying this back for some time as well. But not to want to hug the answer. It looks like Gareth wants to say something.
No, it was only the point I was going to make. Really, was there's so much uncertainty around because we're in another lockdown at the moment. We don't know. Come next year, we may be in another 3-month lockdown. If that's the case, then that's going to obviously put the brakes on the economic recovery again. So we're in uncharted territory, as we discussed, and I think it's very difficult to answer that question. Having said that, it's not all doom and gloom out there because, from an investment point of view, our clients have made money this year in terms of, if you're investing in a diversified portfolio, our clients have made money. So it's, whilst the economic recovery is going to be slow and painful, actually, if you're invested in the right areas, you can still make money.
Yeah. Okay. I expect, Steve, you'd just like to reiterate, come and talk to us.
Yeah, absolutely. So as well, pick up the phone, drop us an email, whatever you like. And if you do want a private client brochure to find out a bit more about how we work and what we do, let us know and we'll get one sent out to you as well. Yeah.
Okay. Well, thank you so much for doing the presentation today, Stephen, and to Gareth and Alex for supporting so well today on our session. I'd just like to remind you of next week's session. We will be same time, same day, so next Friday, 10 o'clock, and we're tackling research and development. We've got a guest speaker next week. So if you have any, it's quite a broad area, and surprisingly more companies can get research and development tax credits than you think. We may also, delve into IP. So let's keep an eye on the website, keep an eye on the LinkedIn and Facebook postings, and please join us next week. And thanks again, guys, for joining us.